If you're enjoying this show, please do me a massive favour and leave a like on the video. It helps with the YouTube algorithm, gets more people to see the video and helps me out massively. So if you want to support what we're doing, that's the best way you can do it. Today we're going to take a look at a company called WH Smith. Hey there guys, how's it going? My name is Chillingworth. Welcome to the FTSE Show, episode number 35. This is the show where we take a look at FTSE stocks and we rip them apart. We look at the financials, we look at the price, we look at whether or not they're a good long-term investment. Listen, I get a lot of people who watch this show. When I say a lot, it's always like one or two people every month or so. But I get these emails from people who are like, why don't you look at foreign stocks? It's in the title of the show. Secondly, why did you say this company were no good when the share price went up this week? Listen, I want to make this very clear. I don't do predictions. I'm not here to tell you whether or not the stock market is going to go up or down the next week. I don't know that. No one knows that. No one can tell you what the stock market is going to do over the next week. It's never been done before. Anyone who says they can do it is just not worth their salt. Listen, I don't know what the stock market is going to do in the next week. I don't know what it's going to do in the next month. I don't know what it's going to do in the next year necessarily. What I do know is that through good analysis, through looking at company financials, looking at trends, looking at how they reinvest their profits that they're making, if they're making any, by doing all this research, by looking at the price and making sure we get in at a fair price relative to the underlying value of a company, using all of these tools, all of these things, looking at the where the company is going, what the company's focus is, and the culture of the business, all of these things added together, you can put the odds in your favour that if you buy this company, that in 10, 15 years' time, the share price will be much, much higher, and you will make great returns on these companies. Maybe not all of them, but some of them. You can put the odds in your favour by doing the right work, by learning the right skills and applying them. What you can't do is predict whether or not a price is going to go up or down in the next week. I mean, you can predict, but you're going to get it wrong just as many times as you get it right. And so when somebody says to me, listen, you analysed this company on this show, you said they were no good, but they're up this week, you're missing the point of the show. Absolutely missing the point of the show. This is a long-term view. We're looking at companies that are going to grow substantially in value over the next 10, 15, 20 years. And listen, there are going to be companies that don't make the grade on this leaderboard that still do well. Hand on heart, I'm going to tell you that is going to happen. Just because they haven't done well in the past doesn't mean they can't turn it all around next year. We're just trying to use the information that we have available to us to make the most informed decision and to put the odds in our favour of doing well. That's essentially what this show is all about. But I could go on and on about this. Let's dive into the numbers of WH Smith today and see what we're dealing with in today's episode. Okay, let's take a look at WH Smith PLC. Epic code's actually SMWH, which is a bit odd, but sometimes they are that way. These guys are in the FTSE 250 and they're obviously in the retailing sector. So taking a look at the numbers, we've got long term from 2008 to 2019, very little if no revenue growth at all. You'll notice back in 2008 revenue sat at 1.3 billion and in 2019 revenue sits at just shy of 1.4 billion, so that's very, very slow revenue growth. And you can really see here that from 2008 onwards it was actually on a downward decline from 1.3 billion, then we started seeing 1.2, then we went down to 1.1, and then it's slowly been growing back up since the kind of low point of 2014 really, and we're back to where we were 2008. So you can't really, whilst 2014 to 2019 has been growth as such, they're still not above where they were in 2008. So whilst in the short term there's some sort of a recovery going on, you can also argue that that's very flat in the fact that over the last 12 years they've really not been able to break through that 1.3 billion a year mark. So that's going to go against them a little bit, because I like to see growth in revenue within these companies. If you're going to find a company whose share price is going to go up and up and up and up and up, you generally going to want to see revenue, strong signs of revenue growth. And like I say, in the short term we've seen that, but long term it's been pretty much flat. So we'd want to see WH Smith surpassing that 1.4 billion mark and continuing that trend of moving upwards now over the next few years, certainly from an investment point of view. Cost of sales are very high, and you can see how the impact that it has on the gross margin. Now, one thing I do like is that gross margin has increased over that 12-year period. You can go back to 2008 and you can see the gross margin there of 5.5%. So they were bringing in 1.3 billion, and they were spending almost 1.3 billion just on the cost of sales, which is a gross profit just 74 million out of 1.3 billion. So really not taking a very big slice of the pie that early on, but you can see that slice of the pie has been increasing, so and it's been getting better. So we have seen a little bit of a drop off in the last couple of years. It's dropped from 11.5 to 10.8 to 10, so it looks like the slice of the pie might be getting a little bit smaller. Certainly been the trend over the last 3 years. We want to keep an eye on that, but even at that level, even at just a 10% slice of the pie, it's very small, it's very low. So we take 2019's data into account only, you're looking at 1.4 billion revenue and 1.25 billion in cost of sales, leaving them with just 140 million in gross profit. Now, it's a lot of money, but in the grand scheme of things, when you're looking at a company bringing in 1.4 billion and they're only taking 10% of that for themselves in terms of gross profit before other expenses are going to be taken out of that, we already know the net earnings are going to be under 10%. Because we've got 10% at this stage, and we've still got money to be extracting. But we can go through here, and we can see that the interest on debt has been historically at around 3-4%. It's dipped down to 1 and 2% in the past, and that's a level that we've been more than comfortable with. That's not an issue whatsoever. It does take some money out of the profits. But there really aren't that many deductions, to be fair. But when we take a look at the net earnings of just the true net earnings of just the recurring everyday revenue of this business, you can see here that in 2008 they were making about 4%, and then they managed to reach up to about 5% in 2010, 2011. Then they hit 6% 2012, 2013, up to almost 8% and hitting 8% in 2014 to 2016, up to 9% in 2017. So you can see there's growing trend, just going up and up and up over the years. This slice of the revenue that they're keeping for the shareholders is going up. The profit is going up, which is great. However, that since 2017 we've been on a downward trajectory. We're down from 9.4% in 2017 down to 8.6% in 2018, down to 7.7% in 2019. So we've lost a couple of percent there over the last 3 years. And we've seen this in the cost of sales going up, and the revenue's not really been growing all that much, and the net earnings has been falling. That's a concern for me. I don't like to see downward trends. That generally doesn't do the share price much favours from an investor's point of view, and fewer and fewer people are going to be interested in this stock when you've got a company that's making less and less, or fewer and fewer profits each year. So that's a worrying trend that's forming, and we need to see WH Smith make some dramatic changes. Now, 2020 is probably not going to be the year for those dramatic changes, so we may be adding a fourth year onto that trend in 2020, and that would be a big concern for me, and certainly a concern for what I would expect the share price to do in relation to that. So in terms of the income statement, not terrible. This is still a company making 7% net earnings a year. I'm not interested in a company that's making 7.7% net earnings a year. I'm not interested in a company that's only making 9.4% back in 2017. This is just not good enough a caliber, not high enough a caliber for the sort of companies I like to invest in. I like to invest in the very best companies that I can find from a financial strength point of view, from a profitability point of view, and many, many other factors. But at the moment, looking at the income statement, I already know I wouldn't be interested in WH Smith. That doesn't make them a bad investment. All it says is, me personally, who has a very high threshold, a very high bar, these guys wouldn't make that grade, but they could still be a decent enough investment. But I am concerned about those last 3 years and the downward trend in terms of their net earnings. Looking at the balance sheet then, moving over to that, they've got 49 million in cash, 174 million in inventory, 73 million owed to them in net receivables. They've got assets. Current assets are pretty much on par with current liabilities. So, you'd like to see that a bit higher, but it's not too bad. It's certainly not terrible. Looking at the total assets of the company, then that's growing. It hasn't grown historically. Back in 2008, they were sitting on 488 million worth of assets. So when we're talking about assets, talking about property, plant, equipment, licenses, like intangible assets, licenses, trademarks, all that kind of stuff, but also the cash they've got in the bank, the inventory they have in their stores, the money owed to them by other parties. All of this adds towards the total assets of the business, and they were sitting about 488 million back in 2008. Well, skip forward to 2012, so several years later, they're sitting on 483 million. So no change. We haven't gone anywhere in terms of the value of the assets over 2008 to 2012. Skip forward even further then to 2017, so relatively earlier, not too long ago. Net assets of, or total assets of 488 million again. So the same as 2008. So from 2008 to 2017, assets did not rise. There's no increase in the assets owned by this business. However, 2018 we rise to 528. 2019 has risen to 746. So some dramatic increases there in the value of the assets. A big chunk of that is in goodwill, so that would suggest that there's been some sort of takeover along the lines. Now, I haven't done my deep dive analysis of WH Smith. I'm not aware of whether there have been any acquisitions involved or anything like that at all. So if you are deeper into this particular company or a current shareholder of this company, maybe you can shed some light in the comments below about why the goodwill has gone up. Normally that's a sign that there has been some sort of an acquisition of some part on WH Smith, and if I was to read all the annual statements like I normally do with the companies I am interested in, then I'd probably learn what those were and what that was all about, because often it's covered in the annual reports. But if you know, drop it in the comments below. That would be interesting to understand what that's all about. Looking at the debt levels, debt has jumped up in 2019 as well. So again, that would indicate maybe they've borrowed some money to buy something. Long-term debt outstanding is now 200 million. Historically, this is a company that's only ever borrowed about 3 to 4, maybe 5 million a year, and had that rolling over. So every year they've only really had about 5 million outstanding in long-term debt. And often had very little in the short-term debt. And so this is a company that really hasn't used debt for probably the best part of 12 years now, but in 2019 they've taken on 200 million of debt. Now, what we always do is we look at the level of debt and compare that against the earnings power of this business. Well, it's fine. They're taking on 200 million. This is a company that's making about 108 million a year, and they've been doing that now for the last 4 years or so. It's worked out about 108 million every single year. It seems to be their magical figure. So it's going to take them 2 years of profits to pay off that debt. That means that the debt levels they're carrying is perfectly adequate for the size of this business and for the power of this business. So there's no concerns from me there in terms of the level of the debt. And so that's a good manageable level. One thing I do like to look at is the equity of the business. So that's essentially the assets of the business minus the liabilities. And if the net assets are going up, then it means that the assets are going up, the liabilities are going down. It might be a combination of the both. It might be just liabilities are reducing. It might be the assets are just going up on their own. But the equity is increasing here at WH Smith, and it has been now for best part of it looks like about 8 years now. So we did see it fall. We've sort of seen it fall in 2009 to about 2012, and then from 2012 onwards we've seen every year the equity of the business has been rising and currently sits at 237 million. So that's healthy to see. I like that. I like to see a company that's growing in equity. So whilst assets have only really been growing in the last couple of years, it looks like they have been reducing those liabilities. So that's pretty good. Looking at the retained earnings then of the company, and again a very similar picture. Back in 2008 they were sitting on 329 million worth of retained earnings, and that was pretty much the same picture in 2016. So from 2008 to 2016, pretty much sitting on about the same sort of money, but it was actually 378 million in 2016. And then it's only been the last 3 years where retained earnings seems to have made a bit of a jump, a bit of a inroads into increasing. And we've seen that jump from 406 million in 2017 all the way to 455 million in 2019, the most recent report. So currently sitting on 455 million retained earnings, which is healthy. That's an annual average growth rate, by the way. Let me just work that out. Over the last 5 years, we take the last previous 5 years and average out what the growth rate is. It's about 8% a year. So that shows that they've got a consistent drive towards pumping money into retained earnings. Now that might be part of an acquisition strategy. They might be looking to buy other companies out, and that's a very positive sign for share price growth. So this is not a bad company, guys. This is what I want to say. It's just not good enough for me, but there are a lot of great stuff going on here at WH Smith. They're buying back their own shares every year. 32 million bought last year in 2019, and every single year prior to that, this company had been buying back some of their own shares. Now, I like that, because that essentially is, if you're a shareholder, it means that your holding in the company is increasing in terms of percentage size, because there's less shareholders. It also means that there's obviously less supply of these shares available, which can often drive up demand and therefore drive up share prices. So that's a great thing to see, and I like that. And the return on shareholder equity, so the equity that they hold isn't very much compared to the actual return that they're making. Bear in mind, there's a company with only 237 million in equity, so assets minus liabilities, and then they're making 108 million from those assets. So they're milking those assets very, very well, and they're making a 45.6% return on their equity, which is very, very good. And so they're not big in capital expenditure either. They're not big spenders there. So overall, looking at this company, WH Smith, I would say that on the whole, this is a very solid business, a very good company. The only small concerns I have is this downward trend over the last 3 years, where the profits have been falling in terms of percentage against the revenue. Revenue's going up, but it seems the earnings are not going up with them, and as a result of that, we're seeing these percentages start to fall. That's a concern for me. Otherwise, it's a decent enough company, just not good enough for me. And I say that because I have some very high bars and high margins that I'm looking for, and I only invest in companies that are really the best of the best companies from a financial perspective, and in terms of what they're doing with their profits, where they're reinvesting them, how they're doing them. To me, as far as I can see, WH Smith are doing everything right. They've just not got the power. The cost of sales are too much. It's eating too much into the revenues they are able to make. They're only keeping about 7% of that, which is just not enough for me. I like companies making a lot more than that. But otherwise, it's a relatively rosy picture across the balance sheet. The balance sheet looks strong and stable. There are no big concerns there. The debt levels, I imagine there must be some sort of acquisition going on if they've borrowed a load of money and their goodwill has gone up on the balance sheet. But I might be wrong. Comments underneath if you can shed any light on that. But they're buying back their own shares, retained earnings are going up, they're getting great return on shareholder equity. There's no real big concerns here, other than the fact that I just like the margins to be a little bit better. And unfortunately with WH Smith, they're just not big enough, and we tend to see that in retail. Retail is certainly a sector where we don't tend to see particularly big margins. So let's go and have a quick look at the chart. Okay, so this is a monthly chart then of WH Smith. I tend to use monthly charts quite often these days because I'm certainly a long-term trader. I don't need to know the intraday sort of ins and outs of every 5 minutes on the chart. But as you can see, they've been a very good company to hold from about 2012 to about 2018. So there's a kind of sweet spot window there where the share price did very well, moving up from around £5 a share, reaching about £24 a share back in 2018. So yeah, a good company. Bear in mind that I've already said I'm not particularly interested in this company and wouldn't have been over the years because their margin just wasn't strong enough for me. When you've got a company that's still ticking pretty much all of the other boxes, you're going to see charts like this. They're still going to be a good investment, and there are companies out there I don't touch that are still perfectly good investments. They're just not quite good enough for me. And WH Smith looks to be a company that historically has done very well. Now remember, from 2017, 2018, 2019, we've started to see a reduction in those net earnings, And with that, we've started to see the share price kind of flatten a little bit. Prior to the start of 2020, however, a real jump in share price in 2019, kind of midway through 2019. Let's check what month that was. We're looking at October, November and December. We jumped from £20 a share to £26 a share over 3 months. Perhaps this increase in goodwill and the increase in debt would suggest an acquisition of some kind or some sort of event that's going on with WH Smith. And if I'd done some research before doing this video, then I probably know a bit more about that. But if you know more, please shed some light in the comments. But over that 3-month period, obviously investors are very keen in this company, because for 3 months in a row we made some significant gains, and then 2020 came along and it's crushed them. It sent that share price all the way down to £6 a share from £26 a share in just 3 months. And yeah, that's a huge cliff that this share price has fallen from. Now we have seen somewhat of a recovery. Certainly in the month of March, we saw it fall all the way to £6 a share, and then finished the month up to £11 a share. So the recovery had already begun in March. April was a good month for most stocks in the UK. Unfortunately, May has not been particularly nice to WH Smith. Clearly, the closures, the lack of revenue is going to be a concern for many investors. And the share price currently sits at £11 a share. So, of course, this crash in 2020 has been an outside influence. It's been no fault of WH Smith as a business themselves. So we've got to factor in that, and factor in the fact that if this company manages to get back into what it was doing, then the future might look pretty good for anyone getting in at £11 a share. Bear in mind, it's fallen from £26 a share because of the virus. If the company recover and start to get back to where they were, then you could possibly see a return to 26 over the long term. Now, it might take 5-6 years to get there. Who knows? It's very difficult to predict where this is going to go and how long it's going to take them to recover. If they ever recover back to where they were again, it's very difficult to know. But I think leading up to the virus, we've got a strong company that is holding its own, that's doing well, that's managing to eke out some growth but struggling. It's not been easy for them, which you would expect from a company like WH Smith. I would say that they would be an average investment. I think they're probably going to score quite well on the leaderboard. Let's go and take a look and see how they get on. Okay, so WH Smith, decent enough company. Just wanted to very briefly talk about the actual pricing financials here. So this is a stock that's trading at about £11 a share, £11.13 I think it was today. We've currently got on that, based on 2019's data, an EPS or earnings per share about 97 pence, which if you were to buy all the outstanding shares in this company at £11.13 a share, then the earnings per share at 97p would give you about an 8.7% return based on today's price. If you bought the company, the entire company, all the outstanding shares at today's price, you'd be getting about an 8.7% return a year. That's decent. It's not amazing. What that tells us is that the price is probably a little bit too high for getting the perfect price, the perfect entry. I think perfect price would probably be about £9-10 on this particular stock, but £11 is fine. It's not a big deal. 8.7% would be good for most investors. We can also take a look at the equity and break that down per share. We're looking at 237 million in equity. There's 130 million shares outstanding. It's going to give you an equity per share score of about £1.82. That would indicate that the share price is probably a little bit too high based on the equity of the business as well. So both of those measures give us an indication that WH Smith, their share price is about £11, is probably a little bit too high for where the perfect entry would be if you're, say, a value investor. Dividend of 5.25% though, that's pretty cool. That's a pretty hefty, decent dividend, so clearly a decent dividend stock amongst dividend investors. But for me, they just didn't make the grade. They weren't quite good enough, and not a company that I would personally be investing in myself. With that, let's get them up on the board. So, strange epic code, SMWH, wasn't it? Not sure why, but obviously other epic codes were already taken. But SMWH score are respectable, and again, I think the scoring system that I use here, the algorithm that I use, is pretty much spot on. Gives us a score of 59 points. So let's get them up on the board. Okay, so a respectable 10th place on the board. I think that's fair. I think relative to the companies that are surrounding them and the analysis we did on those particular companies, I think WH Smith are fairly placed in that position. Like I say, not a terrible company, not a terrible investment. Just doesn't make the grade for me, but they're not a million miles away from a company that I would invest in. They do tick a lot of the boxes. Unfortunately, we lose PZ Cousins. They're gone off the board, only keeping 30 on the board now. I don't think it's going to be long before we start losing the likes of Centrica, Vodafone, Tesco and companies like that. So yeah, it just goes to show just how bad an investment, long-term investment, those particular companies probably are. Certainly not my cup of tea in terms of stock picks. But yeah, well done to WH Smith. I think they are a decent business, certainly doing okay. They're going to struggle, obviously, in 2020 with the reduced revenue that's been coming in, but hopefully people will flock back to those stores when it becomes safe to do so. Thank you so much for watching, guys. I hope that it has added some value. I hope it's been insightful as I do all of these shows. Thank you so much for your support along the way, and I'll see you on Thursday's episode. Cheers, guys.